Hello, I'm Haider Malik, host of the Memi Financial Group podcast. Today's topic is hidden equity, unlocking cash with sale-leaseback financing. If you own equipment or real estate outright, you may be sitting on valuable equity, yet that capital remains tied up in fixed assets. Sale-leasebacks let you monetize those assets, turning balance sheet equity into immediate cash while continuing to use the same equipment or property. Let's explore how this works and when it makes sense. A sale leaseback is simple in concept. You sell an owned asset to a finance company or investor, then lease it back under an operating or finance lease. Your business receives a lump sum payment equal to most of the asset's fair market value, often 70 to 90%, while lease payments replace ownership costs. This transaction converts non liquid equity into working capital for growth, debt reduction, inventory purchases, or other strategic needs. Why consider a sale leaseback? Under 1. Immediate liquidity. Access cash without taking on new debt or waiting for depreciation schedules to free capital. 2. Off-balance sheet potential. With an operating lease, you may keep the obligation off your core liabilities, improving debt ratios. 3. Continued use. You retain full operational control, machines stay on your shop floor, and buildings remain your workspace. 4. Tax benefits. Lease payments are often fully deductible as operating expenses, whereas loan interest and depreciation have mixed tax treatment. Ideal candidates: fully paid heavy equipment, cranes, CNC machines, delivery vehicles that still have useful life. Owned real estate, warehouses, offices, or manufacturing plants with stable utility for your operations. Assets with predictable residual values and solid maintenance records which maximize buyer confidence and advance rates. How to structure a deal. Valuation. Engage an appraiser to confirm fair market value. Buyers typically advance 70 to 90% of that figure. 2. Negotiation. Decide on lease type and term, operating leases for off-balance treatment or finance leases for eventual ownership with nominal buyout. 3. Documentation. Sign a sale agreement and lease contract specifying maintenance responsibilities, insurance, and end-of-term options. 4. Funding. Receive your lump sum at closing, then begin lease payments over the agreed schedule, often matching your cash flow profile. Cost considerations. Advance rate. Higher value assets yield bigger cash injections. Older items or niche equipment may have lower advance rates. Lease rate. Compare lease payments against potential loan payments on the same asset. Factor in interest rates, fees, and tax deductibility. Residual value risk. In an operating lease, the lessor assumes the risk. In a finance lease, you may bear residual risk if you plan to buy out the asset. Example: a manufacturer owns a $500,000 CNC machining center outright. By executing a sale leaseback at an 80% advance, the company receives $400,000 in cash. Under a 5-year operating lease at a blended rate equivalent to 6% annual cost, monthly payments run about $6,900. The net present value of those lease payments, tax adjusted, often compares favorably to a bank term loan, especially when considering off-balance benefits and full tax deductibility of lease expenses. Key action steps. 1. Identify assets. List owned equipment or properties with remaining useful life and high utilization. 2. Obtain valuation. Work with appraisers and brokers to gauge fair market value and likely advance rates. 3. Compare financing. Model lease payments versus loan amortization, including tax impacts and balance sheet treatment. 4. Engage partners. Select a lease provider experienced in your industry to negotiate terms, manage documentation, and ensure smooth execution. Sale leasebacks aren't right for every asset. Machines near end of life or properties you plan to sell are better off sold outright. But for high value, well maintained equipment and real estate you intend to keep, sale leasebacks unlock hidden equity swiftly and efficiently. If you're sitting on solid equipment or property and need growth capital without new debt or operational disruption, a sale leaseback could be the perfect solution. I'm Haider Malik. Thanks for listening, and here's to unlocking the equity you've already built.